If you've ever looked at the stock market and thought, I want to learn how to trade, but this all looks way too complicated for me. Or maybe you've heard people talk about options trading and it sounded like a completely different language. Calls, puts, strike prices, expiration dates. And you just thought to yourself, yeah, you know what? That's not for me. Let me slow all of that down for you today, because what if I told you options trading is really much simpler than other people make it seem? And once you understand the basic idea, everything else starts to make sense. In this video, I'm going to break it all down in the simplest way possible. No fancy jargons, no overwhelming explanations, just a clear understanding of what options trading actually is, how calls and puts work, why options move so fast, and how traders actually make money from them. And by the end of this video, you are going to have that moment where it clicks and you're going to think, oh, that's all it is? Now, before we get into it, welcome to my channel. I'm Suzanne Peters, full-time options day trader, and I'm here to teach you how to trade options for free. If you're brand new, you're in the right place. This channel is built for beginners who want to understand trading in a simple, practical way without all the confusion. So let's start from the very beginning. What is options trading? Options trading is simply trading contracts that are based on stocks. And I want you to slow down with me here, because this is where a lot of people overthink it. When most people think about trading, they think about buying a stock itself. So, for example, if Apple is trading at $200, you buy one share for $200, right? If Apple goes up to $210, you make $10 profit per share. If it goes down, you lose money, right? Simple. Now, options trading is different. Instead of buying the actual stock, you are buying a contract that is based on that stock. You are not owning Apple. You are not owning Tesla. You are not owning Amazon. You are trading a contract that moves based on what that stock does. That's it. And that contract has the ability to move faster than the stock itself. Now, let me explain that in a way that really sticks. Think of the stock like a car driving down the road. Options are like the speed dial on that car. When the stock moves a little, the option can move a lot. When the stock moves a lot, the options can move even more. But if the stock goes in the wrong direction, the option can also drop quickly. So options are simply a more sensitive version of the stock. That's the first important idea. Now, let's talk about the two most important words you would ever hear in options trading: calls and puts. There are only two types of options: calls and puts. That's it. A call option is what you buy when you think a stock is going to go up. So if you believe Apple is going to increase in price, you buy a call option. A put option is what you buy when you think a stock is going to go down. So if you believe Tesla is going to drop in price, you buy a put option. And that's the entire foundation right there. Call means up, put means down. And everything else in options trading is built around that simple idea. Now let me say something that usually makes it click for beginners. When you buy a call, you are not saying, I hope this goes up. What you are doing is making a directional decision. You are saying, I believe this stock is going up within a certain amount of time. Same thing with puts. You are not guessing randomly. You are making a time-based prediction. So let's slow this down a bit more so that you can see how it actually works. Let's say Apple is trading at $200 and you think Apple is going to go up to $205 in the near future. Instead of buying the stock, you buy a call option. That call option might cost you, for example, $1.50. Now, here's where it gets really interesting. If Apple moves from $200 to $205, your option can increase in value to $3 or even more, depending on timing and volatility. What just happened there? The stock moved a small amount, but your option moved a larger percentage. That's the power of options. And that brings us to the next big question people always ask. Why do options move so fast? Well, options move fast because they are built on leverage and sensitivity. You are controlling 100 shares with one options contract. So instead of needing $20,000 to buy 100 shares of Apple, you can control that amount of shares with a much smaller amount of money through an options contract. Because of that structure, even small movement in the stock can create bigger percentage and changes in the option price. But here's another reason they move fast: time. Options have expiration dates. So every single day that passes, the value of the contract is changing. That means options are constantly reacting to three things at the same time: price movement, time passing, and market volatility. So unlike stocks where you can just hold and wait, options are always moving and adjusting. That's why they feel fast. That's why beginners sometimes get overwhelmed. But once you understand this, it actually becomes less scary because now you know why it's happening. Now let's talk about something really important. How do traders actually make money with options? There are really only two main ways. First, traders buy options and sell them for a higher price. So going back to our example, you buy a call option for $1.50. The stock moves in your direction. Now that option is worth $3. So you sell it and you keep the difference. That's your profit. That's one way traders make money. Buy low, sell high, just like anything else, right? The second way is through direction. If a trader believes a stock is going up, they buy calls. If the stock goes up, the call increases in value. If a trader believes the stock is going down, they buy puts. If the stock goes down, the put increases in value. So at the core of it, options trading is really just making a prediction about the direction and timing, and then managing your entry and exit. Now let me clear something up that confuses a lot of beginners. You are not trying to predict the entire future of the stock. You are not saying this stock will go up forever. You are simply saying, I believe this stock would move in my direction within this time window. That's it. Now, before we wrap up, I want to bring everything together so it really sticks for you. Options trading is simply trading contracts based on stocks. Calls means you think the stock is going to go up. Put means you think the stock is going to go down. Options move fast because they are built on leverage, time, and volatility. And traders make money by buying contracts and selling them at a higher price, or by correctly predicting direction and timing. That's the foundation. Everything else you hear in trading, strike price, expiration dates, Greeks, all of that comes later. But if you understand what I just explained to you, you already understand more than most beginners when they first start. In my later videos, I'm going to show you how traders actually make money step by step, so you can see how this works in real time. So make sure you subscribe so you don't miss it. And I want to ask you something. When you first heard about options trading, did it feel confusing or overwhelming? Or is this starting to make sense now? Let me know in the comments. And if you have a question or an idea for a video you would like me to do on options trading, share that in the comments also. I can't wait to read your comments. I'll see you in my next video.